take a property profile or you get to your most recent vesting deed, you want to find out who the owner is. Because many times it could be more than one person, or it can be an entity, like an LLC, or it could be a corporation, a trust. Sometimes you have, especially in an LLC or a corporation, where you have some of the members or the shareholders, depending on which one it is, may not want to exchange. You can't split up an LLC right at the time of you taking a listing and then ultimately going into escrow. So you be careful. You need to find out who the shareholders are, or in terms of the corporation. In terms of the LLC, I'm sorry, corporation is the member. The shareholder is the LLC. And I think I've got that twisted, but whatever, you know what I'm saying? You want to know who's involved. And the bottom line is, if you're taking the listing and it's an entity that's selling the property, the whole thing has to exchange. Now they can buy multiple properties, but even in acquiring multiple properties, after the acquisition, they have to hold that property. That entity that's sold has to hold the property for a minimum now of 2 years. So thank you, Franchise Tax Board, for making life more difficult than even the IRS is, but that's just the rules and that's what they require. So when you take a listing and it involves multiple people in an entity, be careful, be careful, be careful. Call me and definitely have them talk to their tax people, because if they want to split up or someone exchange, some do not, that could be a real problem. They would have to drop and swap or swap and drop, and we'll save that for another day. Here's some issues that people have been asking on a 1031 exchange. Can I exchange and do improvements like build an ADU? Or can I build on land that I already own with a 1031 exchange of a sale of property that I'm selling? The answer to both of those is forget about it. Why? Because the bottom line is you're not buying any property. A 1031 exchange is the sale of investment real estate. It's also the purchase of investment real estate. By virtue of the fact that you're going to build on property you already own, doesn't cut it. The feds will not accept a 1031 exchange, and neither will the state. And ultimately, you'll have to pay the taxes. So if all they want to do is to build on land they already have and not acquire property, it's a problem. They also want to know, can I pay off other loans on other properties that they currently own? The answer is yes, but you'll have to pay taxes on that money. So really the answer is no. You can't do that without having to pay tax. All the cash from the sale has to go into the acquisition, and any debt that's paid off has to be reborrowed on the purchase of the replacement property. If we have a little more time, we'll touch on that. So be careful. Another question I'm getting is, what happens if I go into a mobile home park? Not necessarily the home park, but I want to exchange and buy a property or buy a mobile home that's affixed to the ground or to the land. Can I do that? The answer is it depends. If you're going to go into a lease interest hold on this acquisition, the government says that whether you're selling a leasehold interest or acquiring a leasehold interest, if you want to trade it with real property, either way, the leasehold interest with its extensions currently have to be at least 30 years or longer. If it is not 30 years or longer, it's not recognized as real property, and the government won't let you do it. So be careful if somebody wants to come out of a mobile home or into a mobile home park, because remember, it's personal property. It's a trailer, really, is what it is, until it's affixed to the ground and you either get fee simple title to the property, or a lease with all its extensions will be of 30 years or longer. That's really important, and that's a big issue. I'm still getting this question. I probably will for the rest of my life, at least my professional life. Can I do a 1031 exchange and move into the property at some point? The answer is, don't ask me, and don't even try to answer this. This is strictly a CPA question. Why? This is post-exchange. First of all, the government says for you to do a 1031 exchange, you have to acquire with the intent to hold for investment, not to convert at a later time. Well, that's interesting. Sounds like somebody's trying to use a dial or something. Anyway, the bottom line is, okay, maybe if they can mute their speaker, that might be cool. Anyway, so the bottom line is that you cannot buy with the intent to move in, not even after 2 years. However, if something changes, for example, a medical change that's pretty severe, or a family change that could really, death, unanticipated divorce, there are, or even some kind of a financial hardship where, you hit some very, very lean times and you have to convert the property into a personal residence. There may be room for that after 2 years. But to simply convert it because you held it for 2 years is definitely not acceptable as far as the feds are concerned or the state. Now, a lot of people have told me, well, we've done that, not had a problem. The best example I can give you is for something like that is, have any of you ever driven in a 65 zone, 80 or 85 miles an hour? And the question is, did you get a ticket? Well, the answer is no. And the reason why is because you didn't get caught. There wasn't a CHP there. That's really what it comes down to. Well, I've got news for you. Just in case you haven't heard, the IRS has just spent, with a B, billions of dollars on software. And they're data mining now. You know what that means? That means they can track you and what's happening with you and what you've had been, where you are now. And they can look at transactions and define, why was there a change on a tax deferred event? Folks, I'm going to give you 5 words, and I hope you can remember this, because this will change your life. The government wants your, Michael, money. That's the bottom line. And the thing is that they're tracking it even better now with very high sophisticated software in the billions. And California is going to be sharing in that because they're looking for revenue, because they have to have money because of this COVID thing, overspending, revenue's not coming in as much as it was before. So the bottom line is, be careful, be careful, be careful. Talk to your CPA, make sure it's well documented, and ultimately, in the event that you do need to convert a property that you did do an exchange on, don't put it on Facebook, for crying out loud. Use common sense, right? So that's all I'm going to say about it. Well, whatever you do, don't tell them they can do this. That's not a good thing. Did your parents ever tell you don't do business with relatives? Well, there's a problem here. You know, the IRS has an issue with people doing exchanges who are relatives. You can sell to a relative, and after you finish the exchange, you could actually hold. You have to hold your property, your new property, for 2 years. So if Michael was my brother, and I sold my relinquished property to him, I could do a 1031 exchange, buy something, and have to hold that new property for 2 years. But Michael, at least he's down here based on my view here, has to hold his property for a minimum of 2 years, beginning when my exchange ends. So neither one of us can do this. So I can sell to him because he's a brother, he's a related party. But the government says that you cannot buy from a related party. So if my other, I see a third person here, Mario, if I'm going to buy from Mario, my brother, or my nephew, because I'm probably a lot older than him, who knows. But the bottom line is, if he's my, well, I actually could if he's a nephew, because he's not a related party, he's a nephew. But if he's like a really younger brother and I want to acquire a property from him that I'm doing in exchange as my up leg, I can't buy his property unless he's also doing an exchange. So remember, if you buy from a relative, your up leg, you can't buy from them in a 1031 exchange unless they're also doing an exchange. You can sell to one with a 2-year holding period, but you can't buy from one unless your brother, your younger brother, sister, grandparent, grandchild, children, those are all direct lineage descendants. And according to that definition, that's who a relative is as far as the IRS is concerned. So be careful, like your parents said, when you're working with relatives. Any questions on any of this stuff so far? If not, I'll just keep moving. I want to talk about this one. I've discussed this, but this is showing up again, and it's getting ugly. Did you know on that principal residence exclusion, you know, of up to $250,000 or up to $500,000, you know, if you've had title for at least 2 years and you've owned it, and then you've occupied it 2 of the last 5, you know, they'll let you take the principal residence exclusion. It's an exclusion off of gain. So if I have a $600,000 capital gain off my home here, and my wife and I sell it, and we qualify for the 500, I still have to pay taxes on 100,000, right? Because the exclusion only takes off $500,000 of gain. 250 for an individual. Well, a lot of people have been moving in what they call converting. You know what a conversion is? Well, it's not that necessary. Oh, it could be that, but for as far as this is concerned, a conversion is when I move into property I already own that I haven't been living in, like a second home, a vacation home, or a rental. The government says if I convert a rental or a second home or a vacation home, so for example, let's say I sell my home in Whittier, and then what happens is I move down, and let's say I vicariously have this property in Huntington Harbor or wherever, Corona del Mar. What happens is I can convert the property to my personal residence, and then I can wait for 2 years and sell it. But the question is, can I go back and take all of the $500,000 of gain from the basis of the property? You know what the IRS says now? Because of Congress voting this in? The answer is not anymore. Because of what Congress did back in 2008. It's called the Housing and Economic Recovery Act of 2008. And it basically limits that if you want to convert a property you already own, turn it to your principal residence, stay in there for 2 years, and then sell it and take the 500, it ain't gonna happen. Your CPA is gonna have to go back and look at all the years you've owned it beginning 2009 when this went into effect, and then look at the years that you did live in it, and then come up with some kind of an equation with numerators and denominators, and you will get a part of the 500 or a part of the 250. So if you tell your client you can move into a property, live in it for 2 years, sell it and get the 121, you just gave them really bad tax advice. And Michael, I hope everybody's E&O is paid up, because the bottom line is you might have to exercise that. So be careful. Yes, sir. You have a question?
I do.
Oh, there you are. Okay, you were muted. You just unmuted yourself. Very good.
Yeah, I do. Yeah. So if it was a rental in Corona del Mar and I move into it, if I stay there for 5 years, is it based on a 5-year, like five fifths? So it'll be 100% after 5 years? Where if it's 2 years, it's 2/5?
No, it's more complicated than that.
Okay.
I was hoping that they would do something like that so it's easier to explain, but I've looked at the equation, and frankly, I've talked to some CPAs. They go like this, I hate this because it's that complicated. So the bottom line is that you're going to get a much smaller percentage of what you think you were going to get of that 500 or that 250, which means be prepared to write a check both to the Franchise Tax Board and to the IRS. If you do what? Convert property you already own into your principal residence. By the way, I don't know if you know this, but a lot of states are complaining and have been complaining about the 500 and the 250 principal residence exclusion. that they lose a lot of tax revenue because of that. Well, be careful, because God only knows what the feds are going to dream up in the next few years in terms of trying to collect more money, especially if you enter into a sale. So be really, really careful, or pay attention, I should say. Can I combine the 1031 and the 121 in a piece of property? Well, let's say I sell my home, my capital gain is 600,000 on my principal residence here in Whittier. And then what happens is I use the $500,000, but I still have $100,000 worth of gain. Can I do the 1031 with that? The answer is no. Why? Because it's your principal residence. You're selling it as a principal residence, but there is a better way. And on Valentine's Day, February 14th of 2005, the IRS gave us a love gift. And this is what they gave us. They said that you can now convert your principal residence into a rental, excuse me, and rent it for 2 years. So you move out, you rent your principal residence for 2 years. At the end of that 24-month, call one of you folks, list it and sell it, and close escrow within a year or less. By virtue of the fact that you lived in it 2 out of 5, they'll give you the $500,000 exclusion. But by virtue of the fact that you also have rented it the last 2 years, they will let you do a 1031 exchange on the balance. So you could actually do both and not pay any taxes. So that has not been repealed. I've had people argue with me and say this doesn't exist. I will gladly give you a link to the IRS's website where it spells it out by line, very close to what I just said, but in their own way, so it's a lot longer. But the bottom line is, it does exist. And if they can convert their properties that they raised their kids in, that they've had for 25 or 30 or 35 or 40 years, but they don't want to sell because of the mammoth sized capital gains taxes they're going to pay above 500,000, this can be a really good out. And then they can exchange that into something they don't have to manage. It'll pump income for them. And they can even borrow out of that property after they converted it or before they convert it and take an equity loan and buy something to live in, like a condo if they want to downsize. So there's lots of possibilities with this. And this can be a new way to plan. Michael, how are we doing on time? We're good?
We're good. Sorry, I muted myself.
Okay, good. All right. I want you to know this. This is very important. I'm getting more and more calls on this. Why? Because people are moving out of California and there's a problem. Or they're investing outside of California because they can get a better rate of return. So what they've been doing is they say, Phil, if I do a 1031 exchange, can California come back after me? The answer is yes. California instituted something called the clawback provision a few years ago. I believe it was 2014. It says that in the event that you do a 1031 exchange and you sell your property in California, doesn't matter if you live here or you live somewhere else, you just sell California real estate and you do a 1031 exchange into Arizona, Hawaii, Texas, Florida, wherever you want to buy. And what happens is that you will have to file, your CPA will do, it's one form, but it's called the 3840 form. The 3840 form tells the franchise tax board that they can't claw back and take their tax money from you, as long as you file that form every single year. If you fail to file it, the state of California claws back and they go after you for that tax that you deferred when you did your 1031 exchange on the state portion. And remember, the state portion right now is as high as 13%. And from what I heard from some of my contacts and NAR, they're telling me that the state is now talking about raising the state tax from as high as 13% to as high as possibly 18%. So the bottom line is that this clawback is really important. So as long as you file that form, you're fine. But what if you sell that property and you do another 1031 exchange? So let's say you did a 1031 exchange into Boise and you bought that Idaho property, and then 10 years later, you want to buy a property, a rental that's in Hawaii, my favorite. And what happens is, can you do that? And can California claw back at that time? The answer is no, because it wasn't a taxable event. It wasn't a taxable sale. So you can continue to do this. And as long, if they don't get rid of the stepped up basis, depending on how the election turns out, the bottom line is you can even leave it to your heirs and they can sell the property in California, ultimately will not get any capital gains tax because of these types of laws that are in effect. Any questions about that? That's really a big deal.
I have a quick question about that.
Yeah, Mario.
So basically, if you keep exchanging out of state, in other words, if you keep doing what they intended you to do, and you can sell the property and move it to another state, and then it gets rented and all that, really, so long as you keep doing that, and you're doing it for whatever reasons, like you said, you want to get out of California for whatever reason, it doesn't become a taxable event until you decide to either move in, or at some point sell it to somebody in your family, or you just, so in other words, so long as it keeps going until you die and it goes on to your heirs, as long as you keep doing it, keeping the ball rolling, you're not going to get penalized. Yeah,
the only thing I would change with what you said, if you had a legitimate reation to move in and the feds were okay with it, or they didn't audit you,
exclusion,
it's not taxable. Yeah.
So if you have a health reason or something like that,
right.
Running forever, we're fine with it, and all of a sudden now, boom, something happens, we have to move in, then they're probably going to be like, okay, fine.
Right. Right. That's an incredible deal, folks. For those of you who work with these kinds of clients, this is a big deal right now, the reverse exchange. More and more calls we are getting. The percentages are going up on new reverse exchanges compared to delayed exchanges. Delayed exchanges still far outweighs reverse in terms of numbers. But in terms of the reverse beginning to take more market share, it's actually doing that. Why? Inventory. I mean, the bottom line is, how do you buy something that doesn't exist and you only have 45 days from the time that the sale closes to locate that property? The reverse exchange allows you, through the accommodator, to hold, we have to hold title to the property you're selling the day before you close the purchase. So your client who's acquiring this property can take direct title to the new purchase. If they relinquish the old property into a holding corporation that we have to create called an EAT. It's a holding corporation. It's also known as an exchange accommodation title holder. So we have to form this corporation, take title to the property they're selling the day before the new purchase closes. From the day that we take title to the old property that they're selling that goes into this EAT, the clock starts ticking on the 180 days. They just have to close the sale within 180 days. Big question is, where's the money going to come from to acquire a purchase first? Well, you have to have cash, hard money, swing loan, bridge loan, line of credit. You've got some great people there in your company who do loans. They can help you with that. But the bottom line is that when the sale does close and all the payoffs are made, you are allowed to be reimbursed up to as much new cash that you put into the down payment for the new purchase that had to close first. The government will allow you to be reimbursed from the sales proceeds because you had to float your own money to do this acquisition, or to pay off the hard money loan or the swing loan or the bridge loan or whatever you need. It's temporary financing to get into that acquisition. The government will allow that. Remember, some people can't sleep at night knowing that they only have 45 days to find because they know they can sell. But to acquire, that's another deal. So they can do the reverse exchange. Or another reason for the reverse exchange is, if you can hear somebody knocking on the door here, I should get a little doorbell. Here's something, maybe this will work. Well, maybe not. But the bottom line is that I get a kick on that. But the bottom line, that's so hard, I forgot what I was going to say now. The government will allow you in a reverse exchange. For example, if opportunity knocks on the door and you don't want to lose that property, you don't have to buy it and close it before somebody else gets their greedy little hands on it, the reverse exchange will work. That's the second reason. The third reason to do a reverse exchange is because you're in escrow on a sale, you're in escrow on a purchase. Your purchase is going to close in 3 weeks, your sale is going to close next week, and the buyer falls out. And the lender is not going to loan the money, or they get cold feet and they have buyer's remorse, whatever. Now you have to do a reverse exchange. But it works. It can fix the gap. It's more expensive, but it's worth it to most investors. Not to all, but to most it is. Yeah, you guys don't do this much, so I'm going to do that. Can I just, I just wanted to talk about this. Selling expenses. There's two kinds of selling expenses. There's recurring and there's non-recurring. Guess which one is not allowed in a 1031 exchange? The recurring. What is a recurring cost to sell? It could be property taxes that you'll have to pay. It could be insurance. It could be HOA fees. But the normal maintenance to the property or any of these things I've just made reference to is considered as reoccurring and not allowable in a 1031 exchange. The only proceeds you can take from your sale to pay for in an exchange is non-recurring. What is that? Your commissions, because I have to pay you, Michael, Mario, whoever, Andy, well, whoever, to be able to pay commissions. So that's a cost of sale, one-time cost of sale. Escrow, one-time cost of sale. Title insurance, transfer taxes, recording fees, exchange fees, and one more thing. Anything else that you've negotiated with the buyer that you've agreed to do. If you've agreed to pay for something on an inspection, or they have a problem with something and they want you to either fix it or provide them a credit for it, it is allowable because it's a contractual condition of sale. As long as it's a contractual condition of sale, it qualifies as a non-recurring cost to sell, even if it's maintenance to the building or if it's a repair, because that's not allowed. But if it's a contractual condition to sell, then it is allowed. Does that make sense? Now, this is all on the sale end. This is really important. On the purchase end, very little is allowed as non-recurring. Anything that goes to the lender, appraisal, points, fees, processing, title insurance, because that you're providing title insurance to the lender to get this loan, is considered as recurring. Why? Because the federal government's position or the IRS's position is you're buying a loan, not a property. Now, whether you agree with them or not agree with them is of no consequence. You just have to know that these are the rules. So you can't pay for points and fees and title and all like that when you're a buyer. You can when you're selling the property because it's a one-time event. It's a contractual condition of sale. But on the acquisition, it's for the lender. It's not for you. So the bottom line is the government does not allow you to really pay for almost anything. Really, the only two things I could think of off the top of my head is inspection and escrow, because those are two one-time non-recurring costs to acquire. Unless you hire Mario to be your buyer's agent and you pay him a commission. Now, not many people do that, but some do. It's pretty rare. And if you pay Mario that fee, you can pay for his fees from the exchange proceeds that come out of the sale. And then it's allowable. Because normally the seller pays for the commissions, right? For both sides. But in those rare circumstances, that's how it works.
Question.
Yes, sir.
So, so you're saying, let's say you bought something and you had 250,000 from the exchange, and you're dumping it in, and you're buying a new property with the exchange money. And so you're saying the recurring, so you can't do the lender fees.
Nope.
So if from the 250 that you dump in, you dump it all in, you get your closing statement, it says this is how much you owe, and it comes out perfectly using every penny, down payment plus closing costs using every penny, 250. When you go to do your taxes next year, your CPA will say, well, actually there was about $14,000 in loan stuff, or whatever. You end up getting taxed on that 14,000. That was.
Good question, Michael.
That's
you
the
see
idea.
in red, that's not allowed. The green is allowed on your screen. But
Okay.
to answer your question, it depends on your CPA. Some CPAs are going to say, if they don't audit us, no problem.
So if I don't get caught going 85, then I'm okay.
Pretty much.
Okay. We're back to that.
See, if they audit you, guess what they're going to look at?
The
They're
closing.
going to look at your escrow line item closing statement. And there you are, and then you're dead.
Okay. Got it.
Mario, you look like you have a question.
No. I'm finding this all very, very, I always find this stuff interesting. It's kind of it just makes you think you know a certain thing, how it's going to go. And then it all comes down to the government. If you make any money, somehow, some way, figure out how to make money, the government wants a piece of it. Simple as that.
Well, what were those 5 words I just said?
Yeah,
The government wants your money.
it really, really comes. I mean, you can try everything, and there's a bunch of little loopholes and this and that. But if you make somehow, and you get a property and you bought it 1 million years ago, and it gained a whole bunch of value for no reason, and there's all these little things that somehow, some way, if you come out, somehow, some way, they're going to get you at some point. And if they don't get you, they're going to get your estate or something. I mean, it's just crazy.
Yeah, I hear you. And I think we're coming up the bewitching hour, Michael. Is it usually 2 o'clock? So let me just really quickly. Number one, here's a good example. You sold for $1 million. Your non-recurring closing cost is $70,000. The balance of cash you have is $930. Well, the government says you have to buy a new property for $930 or greater because you have to use all the cash. You don't have to buy it at $1 million. You can, but $930 is the benchmark. But if you have debt that you paid off of $400, first, second, line of credit, whatever, HELOC, all that was paid off at the close of the sale. The $400 from the $930 leaves you $530. The government says that all the $530 goes to the accommodator, but ultimately has to go into the acquisition of the new property. And you have to borrow the $400,000. Remember, if you're selling a property with debt, you have to replace that debt with equal or greater debt, unless you put new cash into the acquisition. So Michael, you go to your B of A account down the street and you have them wire $400,000 to escrow. That serves as debt replacement because it didn't come out of the proceeds of the sale, it came out of your pocket. If you put in $300,000 of new cash, now you're only required to reborrow $100,000 because you replaced the other 3 with new cash from your B of A account. Make sense? So you can bring in new cash into the acquisition, but remember, debt has to be replaced in a 1031 exchange. There's actually a lot more I can talk about, but time does not permit me. Although I would be happy to stay, but I'm sure a lot of you need to go back to work. So let me just remind you of one last thing. I'm willing to do a Zoom meeting for your clients who already own rentals. We can call it an investor seminar. You can call it a capital gains seminar. I don't care what you call it, as long as your clients who own rentals would like to tune in. And we can do this for like an hour, hour and a half, max 90 minutes, where they can just log in and we can be one happy family and answer all their questions and talk about this. Why? because releveraging is the name of the game for these investors. Because the more equity you get, the lower your rate of return is on your equity dollar of income, appreciation, and tax write-offs. That's just the way it works. That's why releveraging is such a good deal. And based on what we talked about today, it's really doable. But Michael, that's for you to talk about with your agents. If you think something like that would be a nice outreach for 24-hour real estate, I would be delighted to volunteer some time, and we can do this on Zoom.
Yeah, I appreciate it. So I do have one question.
Yes, sir.
So I just
$500. No.
Yeah, right? I think I just learned something. So if you're selling something for $1 million, I always thought you had to buy $1 million or higher. Is it true that you based on that, you need to buy 930 or higher?
Good question. Here's the answer.
Okay.
You see in the bottom where it says cash and loan replacement?
Mm-hmm.
You take all the cash. If I had no debt, there's no loan to replace on the property I sold. So I just have to replace the 930 because the non-recurring closing cost is allowed to come out of the proceeds of the sale. If I did pay $400,000 worth of debt, I still have to buy for 930 because I have to replace the cash and now the debt that was paid off. That's how the CPA looks at it.
But what you're saying is it's never, I think we always thought it was the sales.
$1 more.
A dollar more of the million.
Right. It isn't.
Not
You
of,
can.
not
There's
of
nothing
the
wrong with that. Here, let me leave you with this, Mario. Check this out. And Michael, you might find this interesting. And I know I'm a little over time, but you'll find this interesting. What if I bought for $1 million in this scenario, but I didn't put all the cash in? I put in $30,000 in my pocket, but I still bought for $1 million. Guess, and I replaced the cash with more debt. Guess what? That's still taxable because you didn't take all the cash and put it into the acquisition of the replacement property. So you just can't reborrow cash for your personal use, which also leads me to say is this. When you do a 1031 exchange, for all the lenders that we have here, do not over borrow. Because if you do, that's considered as cash that goes back to the client, and that is considered as cash boot. And you'll pay taxes on that, somewhere between 30 and 45%. So don't pay interest and then pay taxes on money because you overborrowed. Make sure everybody's working with escrow in terms of the line item closing statements of how much debt has to be replaced based on what was sold. I know that's probably it for me for now, for you, but
well,
thanks for having me over. I love doing
Bill.
this for you.
Appreciate it. So actually, I asked Christy a question, which I won't give the question to everyone today, but I will next week. I will send you that question, and you tell me what you think before I share it with everyone.